All right, welcome back. So we're going to talk about market efficiency. And as I mentioned earlier, a large part of my research and consulting is on market efficiency. In particular, let me just take you to my firm's website, and you go to washingtonfinance.com, go into research. There is this book of mine on options and market efficiency, a big data approach, where I talk about market efficiency in a lot of detail. This objective measures of market efficiency, applications to securities, class actions, and valuations. Valuations of much more interest to a wide audience, because securities class actions are primarily an American phenomenon. You can download the paper. An option theoretic approach to market efficiency, also you can download it. An arbitrage risk and market efficiency. This paper is a relatively older paper now. It's profiled on Stanford's website. You can also download it. This market efficiency, short sales costs and constraints, it is currently under review. It's also available on there. You can download it as well. So, so as I mentioned, this is a large part of my research is on market efficiency. So it's not surprising that I get very excited about talking about this, because it is actually quite important. All right. Let me share my slides. Okay, so we're going to talk about market efficiency. So first thing to keep in mind is the definition is this idea: a market is called semi-strong form efficient if prices reflect all publicly available information. The important thing here is publicly available information. Later on in the course, in this class, I'll discuss other forms of efficiency. But when in general, when we say markets are efficient, we do mean semi-strong form efficient. It is the standard notion of efficiency of markets. And I've talked about it earlier in this class today. When we're talking about efficiency, we would typically talk about the whole ecosystem. So when we talked about the market for Cedilla stock, and we talked about the law of one price there, we talked about the efficiency of the preferred shares on the Brazilian stock exchange. We talked about the efficiency of the New York Stock Exchange market for the ADRs, and also the foreign exchange market. So a bunch of different things going. So typically, it doesn't make to talk about the efficiency of a security by itself. It's the whole efficiency, whole ecosystem that goes into it. And especially when we talk about an option theoretic view, which is what my book is about, we talk about the ecosystem consisting of the derivatives, the underlying, and the risk-free asset. Okay? So there has been an incredible amount of work on market efficiency and deviations from market efficiency, including works that have gotten the Nobel Prizes. So Gene Fama, 1970, the classic work on market efficiency. And then you have a lot of more recent work by Malkiel, Harris. Larry Harris is on that book on trading and exchanges, which right at the beginning of the course I told you is one of the best books to read on capital markets, especially in U.S. capital markets. So the Larry Harris book is still really, really awesome. Schleifer has done some fabulous work on deviations from market efficiency, or as we say, imperfections in market efficiency. And Paul Samuelson, the great Paul Samuelson, has also done some very interesting work on this stuff as well. So this paper, Fama, Fisher, Jensen, and Roll, 1969, it is one of the classics of all time. It's posted on Blackboard for you to read, and they do an event study. They and the other paper by Ball and Brown. Ball is a co-author, Ray Ball is a co-author of mine and a very dear friend. So they are, in addition to Fama, Fisher, Jensen, and Roll, Ball and Brown, are the founders of modern event studies, which we have done quite a lot of in this course. And they first talk about the fact that a market is efficient if stock prices adjust very rapidly to new information. How rapidly? So I'm going to uh, you see this link to a Bloomberg article. So this is the Bloomberg article, which was that Tesla is facing U.S. criminal probe about Elon Musk's statements. It was a major announcement. Now look at the date and time. September 18th, 2018, 11:42 a.m. The news report came out that Tesla, the company, is facing US criminal probe about Elon Musk's statements. And if you read the first paragraph, um, Tesla Inc. is under investigation by the Justice Department over public statements. Federal prosecutors have opened a fraud investigation after Elon Musk tweeted that he had funding secured. So this was a major event. Before all this, you can have class actions, you can have all kinds of investor suits, but when the US government itself says it is going to investigate uh, uh, Tesla over fraud, it's a major development. All right. Look at the date and time again, September 18th, 2018 at 11:42 a.m. All right. So now let me open file number 33 on Tesla trades. All right. So can you all see the Yuching? Can you see the Excel file?
Yes.
Okay, good. All right. So what's the date on the Excel file? 2018, September 18th, which is exactly the date on that Bloomberg article that I was talking about earlier. All right. So what is this data set? This talks about all the trades that happened on Tesla stock on that particular day, 2018, 0918, from the time the market opened at 9:30 all the way until the night market closed at, 4 p.m. All right, so you can see the last, so their total number of trades on this day, 190,679 trades on Tesla equity on that particular day. So very highly traded security. What is the total average of the security? Total number of shares traded on that on that particular day, 15 million shares were exchanged hands during that day. What is the average size of each trade is 84. So that's quite substantial. Each share is 84 trades a share. The total volume on that day is 15 million. Okay. What is the total dollar value of trades that day? $4 billion. $4 billion worth of trades happened on that one day. It tells you how active the market is for Tesla. What is the average price on that day? We take the total volume divided by, the total dollar amount divided by the total volume. It gives you the weighted average price. Okay, the weighted average price on that day was $286.65. Okay, what is column H? column H is the intraday return from open. As we saw earlier in a different data set that we looked at, if you just take the trade from the return from the previous trade, it just causes, it's an incredibly volatile number and does not fully reflect what's happening on the market. Because, you know, one of the things about a market is it is open on a particular period of time. There is a gap between its opening and the previous day's closing. All right, so there is on the gap. On the other hand, between in each particular period of time, there is these all kinds of trades going on, which is why when we actually work with intraday data, we don't go in more sophisticated analyses. We will often break the day up into a few like 30-minute bins and take returns on the basis of that. So trade by trade return is a bit problematic, but it measures something different. It's not an accurate measure of returns on the security. That's the point I had made earlier. So what we are trying to understand is intraday return from open. So over here, it's $296.30. How much of a return is that from the opening price of $296.35? It is negative 0.0169%. Similarly, this number here is the return from the opening price of $296.35. So that's the intraday return from open. And over here, right at the bottom, we calculate the average, the weighted average intraday return is negative 3.27% for that particular day. All right, that's the weighted average return. So, so we kind of go along 9:30, the market's open, and you know the different kinds of returns. So any negative, I've done a conditional formatting. Negative returns are plotted in red. That's my that's what this spreadsheet is showing. So you can see it's kind of pretty much positive, but small returns all the way. It's still just after return. We see all of these going on. To make our lives, you know, to say, you know, small trades that don't have a lot of information in them. So let's say we restrict ourselves to trades that are greater than 100. All right. So, so this is what we're saying: trades greater than 100, and look at all this. So as we can see, it goes down. You know, markets are going on, and so on. Going back to that Bloomberg article, the article came out at 11:42. So let's see what happens. Let's restrict our attention to after 11:40. All right. So after 11:40, at this point at 11:40, the Bloomberg article has not hit the tape. Okay. So we look down 11:40. The return is actually 1.42. If we look at this, this particular at 11:42.27, 1.4274, 145. There is a pretty reasonably large size trade for 1,000 shares at 11:42.27 at $300.50. Significant, quite a bit, 1.4004% above the opening price. The Tesla's shares going up, not by a huge margin, but still 1.4 for a stock is not too, it's pretty good. So going up. So we go 11:42. It is, you know, 27 seconds. We go going down, and then the first we see, it's still 11:42.48. The first time the stock price goes below the open price. Already we've seen earlier, we'd seen some positive returns. The returns, prices are coming down. It's now come to negative 0.3%. Keep going down. Here it is negative 0.1181%. Keep going down. By 11:42.32, 32 seconds after the Bloomberg article, it's already down by negative 0.75%. 11:42:42, 42 seconds after the Bloomberg article, negative 2%. All right. So we can see that, and and then in less than a minute, it's gone down to negative 3.79%. So in less than a minute, the stock has dropped almost 4%. Terribly bad news. And the stock has responded quite immediately in less than a minute. That's how, and then we see in just over a minute, it's down by 4.5%. In a minute and 5 seconds, it's down 4.5%, and so on. And we keep going, and then by the time it closes at almost 4% below the opening price. Okay. Could there have been other news in there? Absolutely. And that's what an event study is, why we would do an event study, to see whether there were market movements and interest rate movements, everything else, industry movements, everything else. But given that it's a short span of a day, the markets tend to not move that much. Then it's typically the firm's own idiosyncratic information that's playing a role. And we see that during the course of a day, came down by 4%. So as we saw, within 30 seconds, it has reacted to gone down 2%. Within a little over a minute, it's gone down by 4%. And so this is how quickly the market has reacted to this negative news. So so this is an example of a very, very efficient market. Stock prices adjust very rapidly to new information. Okay. And then also 1970, Gene Fama's classic paper, abnormal returns on average are zero in an efficient market. Okay, can somebody quickly, what we don't say abnormal returns anymore, we try to use the word extraordinary return. Can somebody quickly tell me what exactly is an abnormal return? Or an extraordinary return? Extraordinary return is return over and above what is quote unquote normal, what is expected or is ordinary. That's why we call it extraordinary return. So clearly it depends on what a normal return is. Not normal, not in the sense of a normal distribution, but normal in terms of an expected return on that particular day. What is normal return?
Normal return? Would that be the price difference? I mean the capital gain plus the dividend gain?
That's the return, yes. So that's the return. What is the normal return? What is the expected return? Or anytime we're talking about a return, the extraordinary return is something that is the idiosyncratic effect on that particular day over and above what we expect the return to be. So what is that?
So would the normal return be the expected return?
Yes, and what is that? That's what we've been trying to do with the CAPM and the market model and all of those. That's the whole objective of studying those models, is to say what is the expected return that sets a threshold, a benchmark over which you can say anything over and above that or over and below that is the extraordinary or the abnormal return. Okay, so all of those models are attempts to measure or estimate that normal return. Okay, so so what pharma says is that abnormal returns on average are zero in an efficient market, because if not, if the abnormal returns are expectation positive, then there is immediate scope for arbitrage. All right. So as I mentioned earlier, there are other forms of market efficiency. What we have discussed so far is semi-strong form market efficiency. The other forms of market efficiency are, first, is strong form. Okay, let's remind ourselves what the semi-strong form market efficiency is where prices reflect all publicly available information. Strong form is where markets reflect all information, public or non-public. So clearly it's a very strong requirement. So it needs to know, it reflects what firms, their actual earnings are, even if they're not known even to the firm itself. Okay, so this is, for instance, it's saying if a market is strong form efficient, then even insider information should be reflected in the prices. All right, so it's a very strong information, and something that I have found even people who work in finance often don't understand the distinctions between this idea of inside information and otherwise. The weak form is actually significantly weaker. It says that the best predictor of future price is today's price. Okay, that's what often in statistics we call the martingale assumption. That so that's the weak form. That everything else that has gone in the past is immaterial in predicting the future. All you need to know today's price, and that's enough to predict the future price. So all of these articles, you should read them. These are, because it's a fascinating study. These are all posted on Blackboard. Please read them at your convenience. 1 second. All right. Any questions before we move on?
So I actually have one small question about the Tesla case.
Okay.
So would that kind of investigation encourage the speculator to invest in Tesla's stock? So such kind of investigation might bring volatility to Tesla's stock, and would the speculator would they invest more in Tesla's stocks?
Not if the market is efficient, because bad news does not necessarily impact volatility. Bad news will reduce the actual expectation, the mu. It will not necessarily affect the sigmas. Okay.
Oh, okay. Okay.
And what we saw in the data is that the market price, not the volatility, the price actually fell. Price was affected by the news. All right. So in this case, if you think about a speculator is speculating on the price moving in a particular direction in the future. All right. In a particularly efficient market, there are no gains to be had in that way, because all that information is built in to the price looking into it. Okay. So that's the idea of market efficiency. Now, what this idea of a perfectly efficient market, so the idea that either a market is efficient or it's not, is a very old, 1900s, 1990s concept. Since then, nobody really talks about the market is either efficient or inefficient. What we talk about is that, markets are relatively efficient. So the idea is the prices of securities reflect to varying extents all publicly information. Prices adjust to varying extents to new information. Abnormal returns are close to zero to varying extents. So the markets are efficient in varying degrees. So it's a spectrum. Instead of being 0 and 1, efficient, inefficient, it's actually a spectrum. It's not a binary number. It's a number that can range between 0 and 1. And so that's what we call relative efficiency. So Campbell, Low, and McKinley's famous econometrics book actually discusses this in gory detail. I mean, since then, it's you know, in today's world in research, you know, nobody really argues with that. It's pretty much understood that markets are relatively efficient. How relative? That's what the question is, and that's what, for instance, a lot of my research and consulting is all about. On a relative note is the idea of best execution, right? What, for instance, if you are with, let's say you are a broker dealer working with Fidelity, what you are required to have is provide your shareholders, your investors, with the best execution. So that is to say, the best price for your trade is what they're required to provide. So then how do you measure what the best execution is? So in that case, there are various measures, and we're not going to get into detail. For those of you who are interested, please contact me. I've spent a lot of time on worrying about these things, and I'd be happy to talk to you in more detail. So these are various measures of the transactions, that execution prices that were afforded to particular securities. So the volume weighted average price, for instance, there is this idea of implementation shortfall. Implementation shortfall simply means if this is the price at which was prevailing at the time you ordered the trade, what was the prices that you got, and the difference is the implementation shortfall. Or the equivalent, the other side of it, is the price improvement. So what a result of all this is, what has happened, a really major development over the last 10 years, is that this quick order routing. Okay, a lot of this algorithmic trading, for instance, has become huge business. So, you know, you get an order, and immediately, instead of trying to figure out to whom the order should go, you do it algorithmically, because you need to figure out to make use of the slight changes that can happen throughout. Making use of those has become the biggest advantage. And a lot of times the difference between you know, 1/10 of a second and 1/100th of a second can be quite substantial. And that's been once again attempts to make use of these differences. What we often do, and in terms of trying to measure market efficiency, is use event studies. They're not the only way of measuring market efficiency, which once again, some people will say, because people often, you know, finance is something, because we all deal with share prices, we deal with options prices, we kind of think we understand, but a lot of times people really, really don't. And as a result, people will often make very blanket statements without understanding the nuance. Hopefully, once you're done with this course, you will not make those kinds of blanket statements. You will understand that every statement has a nuance, everything is much more complicated than it appears, and that's something to keep in mind. So event studies are one method. And how do we go about measuring these event studies? Measuring market efficiency from event studies is, well, that's what we're going to So Farmer, Fisher, Jensen, and Roll, 1969, as I mentioned, and Ball and Brown, Ray Ball being my very good friend. Event studies have become a fundamental part of financial economics, and these papers are all posted on Blackboard. You know, Kothari and Warner. Kothari is somebody I overlapped with at Rochester. He's now a professor at MIT. So, for instance, they say serve an important purchase in capital market research as a way of testing market efficiency. Kothari also goes on to say that event studies test the impact, speed, and unbiasedness of a market's reaction to an event. And in an efficient market, securities price reaction is expected to be immediate. So also, that's the point that I was making earlier. Systematically non-zero abnormal security returns that persist are inconsistent with market efficiency. So the idea is that persistence. If there is an event, there should be an immediate reaction, and then the reaction should drop off. So if the reaction persists, then it is not efficient, because the immediate reaction should happen. The event should get impacted into the price, baked into the price, and then continue. Okay, so event studies are meaningless if the underlying market is not substantially efficient. Because what we have talked about when we did event studies better, an event study is a joint test of the following hypotheses, plural. The parameter corresponding to the event is significant and the market is efficient. So in particular, if you find that a particular parameter is significant, that could be because that particular event is indeed significant, the parameter is significant, or it could be the market is inefficient. Okay, so in order for you to conclude that a particular event is indeed significant, the underlying assumption is that the market is efficient. Okay, so event studies are very hard to kind of tease things out. You have to be very careful with understanding everything. So event studies are often used to test for market efficiency, whereas the very idea of an event study is based on market efficiency. Okay, so what exactly are you testing? You have to be you need to always be aware of that. All right, class certification, I'm not going to go into it because that's a very substantially US thing. If you're interested, I can talk about that in the future. Okay. So this here, what I have here is Microsoft data. So these are Microsoft data from Words for 2017. These are the returns, daily returns for Microsoft. So this is the value weighted market return.
Professor, we can't see your screen with the slide.
Thanks, Gail.
No problem.
Can you see it now?
Yes.
Okay. All right. So this here is Microsoft daily data. So for 2017. All right. That's just like as we have seen before. Column D is Microsoft's daily returns. Column E is the value weighted daily returns. All right. Now, let's look at so the next spreadsheet, MSFT, is the earnings per share reported by Microsoft. So on all of these dates, so the effective announcement date, the way effective announcement date we calculate is, for instance, if the announcement by earnings. So what does this mean? Look at the first row. On 10/21/1986, Microsoft announced an earnings per share of 0. The mean estimate of the market was also 0. Row 23, on January 18th, 1992, the mean estimate was by analysts. This column C is the mean estimate by analysts was 2 cents, and the reported announcement by Microsoft was also 2 cents. That's what these things are. Now, what's the difference between effective announcement date and actual announcement date? The idea is if the announcement is made before 4 o'clock at night, if it is at 4 o'clock in the afternoon, if it is made during the market hours, then the announcement date is the effective announcement date. If the announcement happens after office hours, after market hours, then we say it's the next. The effective announcement date is the next date. All right. So these are all of these data that you can see. Now, if we look at 2017, what are the data we can observe? So there is on January 27th, at that point, at 2017, the mean estimate by analysts is 78 cents per share earnings. Microsoft announces an earnings of 84 cents per share. Okay. So this is the thing that people who often base their work on analyst report, they'll say, and this is what you'll see on the Wall Street Journal or news reports, is that Microsoft exceeded analysts' expectations on January 27th, 2017. Market analysts' mean estimate was 78 cents. The reported was 84 cents. The next one, on April 28th, 2017, the estimate by analysts was 70 cents. The reported EPS was 73 cents. So there was a 3 cents higher per share reported by Microsoft. So that is what we say. It exceeded analysts' expectations and so on. Now, one thing that I actually do in my research, I say, just because you exceeded analysts' expectations does not necessarily mean it was good news for the market. Because good news is not the relevant thing when we are doing market efficiency. It is whether it is better than expected. So that's what we need to know. So for instance, here it says it exceeded analysts' expectations. But we don't know for a fact what the market as a whole thought of Microsoft's earnings at that point. So whether this difference between 84 and 78 cents was actually an unexpected surprise, that is not possible for us to fully tease out from this fact that it is exceeded, because we don't know for a fact what the market actually thought. All right. So now let's just now look at what we're trying to do now. We say, all right, let's see if these particular earnings announcements, they were all exceeded analyst estimates, not necessarily market estimates, they exceeded analyst estimates. Did they have a significant impact on the market for Microsoft stock? So let's do an event study. A very simple one, but let's do it. So how do we do that? First, we say we put in dummy variables because we are trying to estimate the significance of these announcements in 2017. All right. So we put in dummy variables. What are the dummy variables we put in for the first announcement? So it is 0 all the way. The only ones are at the first announcement was on 1/27/2017. So we put in a 1 for the day of the effective date and one more day. We say that we taken to be grant that it takes the day of the announcement and the following day for these, if there is an unexpected component to this announcement, for it to be baked into the security. All right, so we put in dummy variables for the effective day and for the next day. So that's for the first announcement. Similarly, the second announcement is on 4/28/17. So in order to do our regression, our event study, we put in zeros all the way, and then ones only for the day of the second announcement and the next trading day. Okay. Similarly, for the third announcement and the fourth announcement. Okay. Now what we're going to do, we're going to do a regression where, excuse me, the left-hand side, the regressand is the daily return of the security in question, Microsoft. We control for the market movement by having in, this is the market return, value-weighted return, including dividends, and we put dummy variables for each of the events that we are testing the significance of. So when we do the regressions, this is what the result we get. So the first announcement, the coefficient of that is 1.2%. Remember, it's remember from event studies that we did earlier, it is the coefficient on it's the lambda on the particular event study. This is, so this represents the abnormal return that you can attribute to that particular event, controlling for the market. So that is significant. The second announcement coefficient is 0.9%, which is not significant at 5% level of significance. The third announcement is in fact negative, but not significant, thank goodness for that. And fourth announcement is actually 3%, which is economically and statistically significant with a p-value only 0. So the first announcement is statistically significant. The second announcement is statistically and economically significant. So the surprises were, all four of them were surprises. The first one had a surprise of, 6 cents. The third one had a surprise, positive surprise from, now remember, this is not necessarily a surprise from the market's perspective. This is the exceeding from the analyst's expectation, which is not the same thing as that of the market, was 27 cents. Okay, in the third quarter, Microsoft beat analysts' expectation by 27 cents per share, and yet the third announcement has no positive significance. Is Microsoft stock efficient? Well, we have to question that, right? And finally, what is the fourth one? Fourth one is a 10 cents per share expectation, 10 cents per share exceeding from the analyst's mean estimate, and the regression results are 3% of that abnormal return, which is also statistically significant because the p-value is only 0. All right. Now, remember, an event study is based on the underlying assumption that the market itself is efficient. All right. If the market itself is efficient, then all of these, and if indeed analysts' expectations are a measure of how the market itself was viewing it, then all of these should have been significant, but only 2 of them are. Right? So this is something we have to, this is an example of the nuance with which we have to treat any kind of event study to evaluate market efficiency. But Shing, this is kind of what you were discussing earlier. Look at the level of volatility. The blue returns are the Microsoft, and the orange returns are the markets. And the markets, as you can see, as we have seen before, is much less volatile than Microsoft's. All right, I actually, if you'll have to excuse me, I need to go to the bathroom. Right, sorry about that. All right, let's go back to the slides. So as I mentioned, I'm not going to spend too much time on class certifications because that's almost a uniquely US thing. So what are the various measures of market efficiency? All right, so one of the things is, what exactly is the role of, how does market efficiency happen, and what is the role of the arbitrageur, or as Shing mentioned, a speculator? Is the idea that market efficiency, how does market efficiency happen? Is through activities of these people. So if a price is, you, let's say Gail, you are an arbitrageur, you see that you think, based on your best information, that the price of Microsoft is higher than it should be. Okay, if you think it's overvalued, then you will sell the security. You'll go short. And short selling might, as we have discussed before, you can just sell. You can even sell if you don't own any stock. That's going, that's a naked short, and that's possible as well. And there are some various work on that one, and that's something that I have done a lot of research on, these short sales costs and constraints as well. Similarly, if if you think that a particular stock is undervalued, then you will buy it in order to sell it for a higher price in the future, right? But it is in the process of your buying it that you will move the price up to its appropriate level. So the idea is security correction of mispricing, which means moving a market to a more efficient outcome, occurs through arbitrage activity. So Pontiff, Jeff Pontiff, who actually was a year ahead of me in graduate school and became very good friends when we were in Boston. He was actually, my wife was a student of his at Boston College. So Pontiff's famous work of 2006 in the Journal of Accounting and Economics, which I've also posted on Blackboard, he makes the point, idiosyncratic risk. Remember idiosyncratic risk from our CAPM and market models say it's coming back to haunt us. So idiosyncratic risk is the single largest cost faced by arbitrageurs. It's the single largest barrier to arbitrage, and therefore, higher the idiosyncratic risk, the less likely the market for a security is likely to be efficient. All right. So it is one of the measures of market efficiency. Arbitrage risk is a generalization of idiosyncratic risk, which I have discussed in these slides, and is also discussed in our paper of 2015, which is profiled on Stanford's website, and the article, and also this this paper of the market efficiency, short sales costs and constraints and trading volume, that's also posted on Blackboard. It is where I talk about various different measures of market efficiency, including idiosyncratic risk, arbitrage risk, and the extraordinary returns that we discussed earlier. All right, we take 8 different measures and do a very heavily big data work, you know, with incredible effort placed on robustness of results. So, so those are the 4 measures that I discussed based on event studies. And what are the events I focus on? One is the Standard & Poor's actually characterizes events as key developments. So I say take any key development and I calculate the abnormal return, and I have to do some adjustments to take care of the idea that there should be a reaction, and the reaction should die down in a couple of days. So I have to adjust for both of that. Please read that paper if you're interested. So that's one thing I do with all key developments. I also do with earnings announcements. And so, so I take a bunch of different measures, 8 different measures in that particular paper, and then ask the question: is market efficiency significantly affected by trading volume? One would think. And the second question I ask is market efficiency significantly affected by short sales costs and constraints? And turns out both of these cases, the results are not very strong. Okay. And I also in the paper put forward a theoretical model and the empirical model, and we say, you know what, it's not very surprising that they are not affected. In the other paper, another paper, an option theoretic approach to market efficiency, which was published last year in the Annals of Financial Economics, which is also something I discuss in my book, which came out earlier this year. So there I talk about deviation from put-call parity of options on a stock without dividends or splits is another measure of market efficiency, not only of the underlying security, but of the options market and the fixed income securities market. So it's efficiency of the entire ecosystem. And so I take those measures and again, ask the same questions. Is market efficiency significantly increased by trading volume? And the answer is no, not really. Question also is market efficiency significantly decreased by short sales costs and constraint? And the answer is again, not really. It's funny when the answers are, well, it depends. And that's just the kind of nuance we expect of very complicated markets. And so we have to understand the American versus European options, and that's something that's I'll get to in just a second. Put-call parity deviation from remember, put-call parity for European options is equality. Put-call parity for American options is inequality. So that you have to adjust for the deviations from that. I also talk about implied volatility. One thing, remember, we have discussed this. Implied volatility is a measure of the volatility as the market investors in options think about the underlying security, So in particular, implied volatility on a particular day should be the same for all puts and call options with all strike prices, with all maturity dates. should be the same in an efficient market, or more correctly, in a perfectly efficient market. So the more you deviate from that, the more you can say the market is less efficient. So that's the relative efficiency argument. And then you say, is this relative efficiency increasing in trading volume? Is it decreasing in short sales costs and constraints? Can you take a particular market, a particular security, and say what the efficiency of that particular security was? Yes, you can. You can say, you can come up with a relative efficiency number. That by itself may not be very interesting, but what you can do is to talk about where it stacks up against the entire market, which we will discuss in just a second. All right, so for American options, remember the put call parity is an inequality. So the deviation from that, it's saying if it falls within the inequality, that's what the inequality of the put call parity for American options is. It is 0. And otherwise we say how much, if it is to the left of it, how much to the left. So the band in the middle, inequality, there's a band in the middle where it holds. In that we say that the price spread is 0. If it is to the left, how much to the left? If it's to the right, how much to the right? That's what we take as the measures of market efficiency for American options. For European options, it's pretty straightforward, simply because it's an equality. And so anytime it deviates from that, we can talk about it. Implied volatility, as I mentioned, it should not depend on whether it's a call option or a put option or and so on and so forth. So I take a bunch of different measures of this deviation from implied volatility being constant for a particular day and come up with various different measures of market efficiency. The point that I'm trying to make to you is market efficiency is a very, very, very complicated thing to measure. So as a result, we really don't know what the efficiency of a market is. All we can do is to come up with various different measures and see how robust our results are. Okay, this simple model of trading volume, you should read it at your convenience. I'm not going to go through it, but as I mentioned, this is something that we need to, So what are the questions? The conclusions from the trading volume is that, first thing that people often say, and it is so, so preponderant, especially outside of finance, academics. People, I remember being at a Georgetown conference last year, where the president of the New York Stock Exchange, somebody you would think knows stock markets, right? She went on and on about how this market is heavily traded and therefore the market is efficient. I went up to her later and I said, you know what, trading volume has got nothing to do with market efficiency. And she said, yeah, you're right. I'm like, okay, if I'm right, why did you just make that wrong statement? Well, it is. And lawyers in particular are notoriously bad in making those kinds of statements. Even people who ought to know better, lawyers at the SEC, will make statements like, oh, the more highly traded it is, the more efficient it is. Turns out it is not. And this is the part, in finance research, people will often say, why is this even a question? Of course it doesn't depend. It is, we finance professors, we understand that this is a completely different, and I'll talk about in this. And in the theoretical model as well, we asked the question, market efficiency on short sales costs and constraints. That's also an empirical question. All right, so a positive relationship of trading volume with market efficiency is often considered so obvious to not even require proof. So in the CEDIA complaint and the expert report, which I was involved in, not as the testifying expert, I kept telling the testifying expert that you cannot make argument, but he said, you know what, I'm going to make it anyway. And the Kammer Court, in law, it is considered so obvious, but it's just not true. And why is that not true? As Wang, in the classic Journal of Political Economy 1994, talks about, investors trade among themselves because they're different. All right. let's consider this. All right, no, let's not consider a bottle. All right, CUA. I cannot see your camera. Let's take somebody whose camera I can see. ED, can you see me? Can you hear me? Can you hear me?
Professor, can you hear me?
Yes, I can. Okay. All right. Now, if you think that a Tesla stock is worth $500, and I think it is worth $500, will we have a trade?
No, we will not have trade.
Right. On the other hand, you think it's worth $501 and I think it's worth $499.
And we will have a trade.
We'll have a trade. So trade happens only because investors are heterogeneous. Investor valuations are heterogeneous. As Wang famously says, investors trade among themselves because they are different. What has heterogeneity got to do with market efficiency? More heterogeneous a market, the more efficient it is. That's the argument that these lawyers are making. It has no foundation in finance. Okay, so there is no reason to believe higher investor heterogeneity facilitates market efficiency. There is absolutely. It can generate noise. You can have a lot of noise trading, but it's got nothing to do with efficiency. Okay. So number of market makers, again, this is for those of you who are interested in the industrial organization idea. What determines the demand for market making is higher trading volume. So if there is higher trading volume, there will be more incentive for market makers to enter the market. And so once again, if it is purely a function of trading volume, and as we just discussed, trading volume has got nothing to do with whether the market for a particular security is more efficient or less efficient. The number of market makers also is not a determinant of market efficiency. Once again, lawyers will say it like it's a statement of fact, even judges, because judges are lawyers, and a lot of the laws in the US in particular are so based on what lawyers think rather than on the basis of proper financial economics. So these are the kinds of things you need to bring to the table and make sure you are following it from the proper, rigorous intellectual way. The comparables method of valuation is something that if you haven't done already, you should be doing. If you have taken any courses in valuation, the first thing that often people do is comparables. If you're buying a home, for instance, and you're looking at any of the real estate valuation sites like Zillow, it is always about the valuation of your home with respect to some benchmarks. Okay, that is the way, that is the first method of valuation that people in general do, is the idea of comparables. All right, so hang on just a second. So what is a comparables approach? So you say Facebook is, you're trying to, let's say, measure the valuation. What is the valuation of Facebook? All right, you're trying to figure out what price it should be IPO'd at, what price one should pay for it, all of these questions. And you say, well, Google and Yahoo are comparable securities. All right, then what we say is, let's say, what is the metric that you're going to use? One of the things that we often do is we take the price earnings ratio, and I'll get to that in just a minute in the terms of what the price earnings ratio means, and we'll do some examples. So price per share, which is what you observe, earnings per share, which you observe. The ratio is an element measure of the growth of the firm. Let me just quickly, the PE ratio The first equation there is simply the sum of a geometric series, which you're very familiar with. Now let's take a very simple assumption that earnings grow at a constant rate G, and the discount rate is constant R. So the value of the firm equals price times number of shares, price per share times number of shares outstanding, PS. The value of a share is equal to this is the discounted cash flows model that that you've seen before. That is ultimate, so is equal to the summation sum from from 0 to infinity, 1 plus R, because that's what you're discounting it by. And the earnings are growing at the rate of G. So 1 plus G raised to the T ES, where E is earnings per share. So you do the manipulations. This turns out to be 1 plus R divided by R minus G times ES. So P divided by E, the price earnings ratio, often called gamma, because it is a function of the market's estimate of the growth of the firm. Okay, as you can see, the higher the G, the higher the gamma. All right, so this is a very simple. I'm just trying to get you to understand that the price earnings ratio is an idea of how the market views the firm is going to grow in the future. Okay, that's what the price earnings ratio is. Now, so this using price earnings ratio, so the idea would be, you say your comparables are Google and Yahoo. So you estimate what the price earnings metrics are for Google and Yahoo and apply it to your security of interest, your asset of interest, and apply it there. So for instance, in real estate, you would say you take all the neighboring houses and you say, what is the price divided by square footage? Some simple metric like that. And you say, I'm going to take the average of all those in the surrounding neighborhood, apply that average to the house I'm trying to measure. And that's the idea of a comparables valuation. So price per earnings ratio is a very standard metric that is used in valuations of companies. Now, why was price per earnings very difficult to do in the 1990s, and is it still difficult to do for tech stocks today, for startups today? Rundan, would you like to can you tell me why you think, or why it is true? Why is that a problem for tech stocks?
Hello, can you hear me, Professor? Hello?
You have to speak up, please.
Hello? Let me see.
I cannot hear you.
Okay, so can you hear me now?
Just about.
Okay, so can you hear me?
Yes.
Okay, I'm sorry, but Professor, could you please repeat the question?
Okay, let's go to the next slide. This price divided by earnings makes sense only if the earnings per share is positive. If earnings is negative, earnings growing at a constant rate would make the firm valued negatively. That wouldn't work. So price per earnings ratio for tech stocks often won't work because the earnings for tech stocks, especially at their growth, at the initial stages, is often negative. So in the 1990s, what was a standard thing in the finance world is to try to figure out what alternative measures can be used instead of the price earnings ratio, because the price earnings ratio were not meaningful because earnings, the denominator, was often not positive. All right. So that's something to keep in mind, that this price earnings ratio can only make sense if the earnings is positive. How does it all relate back to efficiency? All right, so the valuation idea using comparables, it can be about a stock that is not even traded. However, if it is traded and you're trying to find the appropriate price based on comparables for it to be equal to its traded price, that's when it is efficient, because we're talking about the deviation, the actual traded price should be equal to its appropriate price. That is where mispricing is zero. That's where the market is close to being efficient. All right. So the valuation exercise therefore depends that Google and Yahoo, the comparables, are also trading on efficient markets. So the whole idea of comparables valuation is that the comparables are also trading on efficient markets. In particular, let's say we're talking about the valuation of our family home. If you're going to use the comparables, the fundamental implicit assumption is that the comparables are actually appropriately valued, which is, of course, which means the markets are efficient. So when you say a rejection of the null hypothesis, we say, okay, Facebook is not correctly valued. Okay, you say, look at the appropriate value of Facebook, and you look at the traded value, traded price, and you say they're not equal, and the trade is significantly different. So you reject the null hypothesis. It could be because Facebook itself is mispriced, or it could be the comparables are mispriced. You have no way of distinguishing between the two situations. And that is exactly why market efficiency is such an important thing to keep in mind. Let's look at some results. So I'm going to open Excel file number 36, which is price earnings ratios. Okay. Gail, can you see my Excel file?
Yes.
Okay. So this here is file number 36, which is what it does. It takes the year and quarter. Column B is the ticker. Column C is the company name. Column D is a business description. I'm going to shorten it. E is the SIC code, which we have discussed numerous times, the standard industrial classification. This here is the earnings per share as announced. And this here is the price, at the close of that quarter. This here is the price earnings multiple only if earnings itself is negative, is positive, because otherwise it's meaningless. So we've done some conditional formatting. All the rows which have negative EPSs are in red, and the PE multiples are missing for those because they are not meaningful. Okay, so remember, if the earnings per share of a firm is negative, you're saying it can only, that firm still can have a positive value only if that is an unusual situation. It will eventually have positive earnings, because if it always has negative earnings, it cannot have a positive, the valuation cannot be positive. All right, so that's something to always keep in mind in terms of doing the price earnings ratio. So let's just look at this ticker of the first one here, AAR Corporation. So starting from 1998, quarter 4, the prices go from 25.25 to 17.06. The EPS starts out at $1.40, goes down to $1.59, then drops down quite significantly. And then in 2015 Q2, again, it goes negative. And by the end of 2018, it's up to $2.34. What is the price per earnings PE multiple, the price earnings ratio? In 1998 Q4, it's $18.04. In 2001 Q3 is 28.93. In 2004 Q2, it's very high, 68.43. Why is that though? Is that necessarily indicative of the firm actually growing very high? Also to keep in mind is that the EPS was particularly low, close to zero on that quarter. So you're dividing, the denominator is pretty tiny. So that's why the PE multiple looks kind of inflated. All right, so it varies a lot. So this is AIR. Who cares about AIR? What we care about, let's look at some firms that we actually care about. Let's look at Apple, for instance. Okay, so 1998 Q2, the Apple's earnings per share is only 14 cents. It actually had a pretty bad quarter in terms of earnings. Look at the earnings for around it. It's quite a bit above $2. That particular quarter, second quarter of 1998, it had a very low EPS. The price earnings multiple was, once again, it's very inflated simply because the denominator was low. So we can treat that as an outlier. The point to make, again, if you look at 2001 Q2, also, it looks very inflated because it's just unusually low. Now in 2001 Q3, it actually had a negative earnings per share. And that's, you know, the 9/11 scenario, you know, everything was different. So we see negative earnings. And so we have the price earnings missing. Again, we see kind of in the 40s, then, you know, it goes up to 80 in 2002 Q3. That's when Apple's starting to announce that it's moving from purely a computer manufacturing company to more iPods. Look at the, in 2004 Q1 to 2005 Q1, it is the PE ratios in the 50s and 60s. Those are very high. This is when the iPod is coming out. Finally, Apple is moving into something quite different. So if a firm moves into something quite different, the market will view its growth as quite different. So that's not surprising at all. So then we go on to closer to what term. What we see now is a much more, in the 2017 and 2018, the growth PE ratio is in the 16s and 17s, which is basically the market saying, well, Apple's growth has kind of flattened out. We're not going to see those huge, humongous growths that we saw earlier. All right. So that's something, if you want to understand how the market views a particular company, looking at these massive price earnings ratios can give you a significant understanding of this. Let's look at just a couple more firms and we'll move on. Let's look at Facebook. All right, Facebook, it wasn't publicly traded until 2012, quarter two. So no wonder we don't have these price numbers because there were no prices. Look at the growth rate in 2012 Q4. That's, as we think, it's kind of an outlier because the earnings is pretty low. But let's look at the numbers in 2013. So it is 90s, 70s, so close to 100 PE. So between 70, 80, 90 per price earnings ratio. It's a rapidly growing firm. Look at the numbers right toward the end of 2018. It's significantly lower from the 70s and 80s to the 20s and 30s. And the reason is quite straightforward. Facebook's ultimate demographic is me and my family and my colleagues. People who are, we are in our 50s and 60s. We are not growing. Many of you are not on Facebook. When I actually do searches, my daughter is not on Facebook. It has no interest in going on Facebook. And the younger generation, people, the growing demographic are not on Facebook. Facebook has lost its appeal to the growing generation. Its appeal is to people like us who are not growing. Okay, so if you see the PE ratio, Facebook has plateaued. Facebook has, all right, let's look at Amazon. And I want you to keep this in mind when we look at, okay. So Amazon was negative EPS for quite a while. When it first started trading, the EPS was so tiny that 657 number is not, it's kind of an outlier. But look at these numbers. Look at the numbers for an online trading giant. In 2017 and 2018, everything in the hundreds, 150s, 200s. That's the price earning ratio. That's what the market thinks Amazon's going to be growing. Okay, the PE ratios are, we don't see a single PE, well, initially there were some double-digit PE ratios, but more recently, and the growth in Amazon, and if we take the more recent numbers, if we take the 2020 Q1 results when they come out, it will be very interesting to see what the growth rate of the market is for Amazon going forward. But the point is, as for an internet player, the market ascribes a PE ratio that is significantly higher. Finally, I want to show you Walmart. Walmart, has been around for a very long time. It's a brick and mortar, huge brick and mortar retail giant. 1998 Q2, it's a boring old brick and mortar retail player. PE ratio of 36, 21, 17, and so on, all the way here. Now look what happens in late 2018. The PE multiple jumps into the 50s. What happened? What's the difference?
New tech.
That's correct. Walmart makes a concerted move into online retail. So in that period, Walmart, it has its brick and mortar store, but it's now competing with Amazon. As a result, the market's valuations of the growth, not quite Amazon level, not in the high 100s, but it's significantly higher than what it used to be. All right, so this is, once again, an idea of how market transformation of a firm changes its valuations and its PE multiples. Any questions before we move on?
Yes. So when looking at P ratios and trying to analyze them, would it be safe to say that you can't really look at it for one period of time? You have to look at it like the changes of it.
Exactly, Gail. Exactly. However, for one period, if you are, looking at deciding whether to I was actually talking to one of my old Georgetown students, and she used to work at Walmart e-commerce. And it was so fascinating because it was completely about that. So the fact that e-commerce of Walmart has significantly caused its growth to increase and how the markets perceived it. As we saw, its PE ratio has changed over the years. But now, if you are talking about investing in Walmart today, all you care about is price today and price in the future. So whether the PE ratio was in the 20s 3 years ago is not quite relevant anymore, right? All you care about is the PE ratio today. So it depends on what you're trying to do. You know, every metric has some role. It measures something. Question always is, instead of saying this is irrelevant, it's irrelevant to what? What is it you're trying to do? And does it measure what what you're trying to do? Yeah?
Okay, thank you.
You're welcome. All right, let's go. We're toward the end. Let's kind of look at some results, actual empirical results on market efficiency. So if you take arbitrage risk as a negative proxy for market efficiency, this is from that paper, 2015 paper that is profiled on Stanford's website. So turnover is market efficiency. Turnover simply is trading volume divided by shares outstanding. What proportion of your entire amount of shares are turned over on a daily basis? So we find that turnover is negatively related to market efficiency. Conventional wisdom, as we said earlier, is inconsistent with conventional wisdom. But, you know, as we also say, conventional wisdom is wrong. A number of analysts also find negative, but significance is ambiguous. Ambiguous by definite, but we talk about it by using White's heteroscedasticity stuff. This is not a financial econometrics course. We kind of say it's ambiguous if by correcting for heteroscedasticity, you get a different significance result. Number of NASDAQ market makers is negative, the relationship with market efficiency, but once again, that's not surprising. Bless you. Interestingly though, market efficiency increases with market capitalization. That is empirically true. And the reason is actually quite interesting is that if a market, the bigger the firm, it is more carefully studied by the market. And therefore, the prices tend to reflect the actual valuations. Bid-ask spread is negative. Makes sense. You know, the higher the bid-ask spread, that's bid-ask spread is the cost you incur in trading in a firm, in a firm's equity. So the higher that cost is, not surprising that market efficiency will be lower. Public float ratio is positive. Not quite sure what to make of all that. Institutional ownership ratio, market efficiency is positively related to that. And the idea is institutional owners, institutional investors tend to be more active traders. They are more informed traders. So the higher the amount of your shares, proportion of your shares owned by institutional investors, the more they are likely to price it correctly. The other things, we can just go on. Some of the more recent papers, which actually using structural model. The previous thing that I mentioned is using just one equation, reduced form model. This, once you use much more sophisticated models, then if we test the null hypothesis that market efficiency, the null hypothesis is the market efficiency as a function of volume is non-positive. The alternate hypothesis is that is positive. Then we find that there are actually very few rejections. So which is to say that the null hypothesis is on the whole not rejected. That is to say that it is market efficiency it is not accurate to say market efficiency is significantly increasing in volume. That alternate hypothesis is not supported by the data. Okay, this is a one-tailed hypothesis, which is slightly more difficult to fully understand, but that's what these results are. Similarly, if we ask the null hypothesis is that market efficiency as a function of short sales costs and constraints, The alternate hypothesis is that market efficiency is negatively impacted by short sales costs and constraints. That's the alternate hypothesis. Once again, one-tailed hypothesis, not what we are used to seeing, but it's kind of much more advanced than your standard econometrics. Turns out we can see the very few rejections. If you look at the proportions, they're kind of tiny. Yeah. So, which is to say that that hypothesis, that the conventional market efficiency hypothesis, that the higher the short sale cost and constraints, the market efficiency is likely to be lower. That negative relationship between short sales costs and constraints and market efficiency is not supported by the data once you put in a sophisticated econometric model with a big data approach. We're saying this is based on every single stock traded in every single market in the US over a period of 20 years, every single day. That's how we are basing it. Once you take that approach, instead of trying to make selections, this is what the results you're going to get. So the bottom line is market efficiency is very interesting, very important for litigation, for valuation, for all these purposes. And one needs to have a very nuanced approach to understanding market efficiency, because a lot of the stuff that people say are just not true once you look at the big data in terms of advanced econometrics. Any questions?
Professor, so when we are trying to figure out the empirical questions about the market efficiency, what would be the dependent variable over there?
Oh, the regressand, the left-hand variable is market efficiency, the different measures of market efficiency. So go back to so all these measures of market efficiency. So for instance, idiosyncratic risk is one measure of market efficiency. Arbitrage risk is another measure of market efficiency. The abnormal return based on key developments is a measure of market efficiency. Abnormal return based on earnings announcement is a measure of market efficiency. Deviation of put call parity based on relative price is a measure of market efficiency. Deviation of from put call parity on the basis of implied volatility is another measure of market efficiency. So when you have 12 different measures of market efficiency, that's why you have so many different regressions. Number of regressions, 120. Okay, so you have, in this case, different regressions based on these different measures, different left-hand side variables, different regressands. Okay, and then you put in fixed effects for various different measures. You say, you know what, I'm going to control for book to market ratio because that's what people have said determines efficiency. Some people have said leverage. Okay, fine, I'll control for it. Some people have said market cap. Okay, I'll control for it. Some people have said price earnings ratio. Okay, I'll control for it. Some people have said institutional ownership. Okay, I'll control for it. And this is the idea of a big data work. Instead of saying which model, you say all of those. So in this case, this is the fixed effects model. I use 120 regressions. If you look at the ones where I actually do separate regressions for each of those get into the thousands. Okay, and then for that, again, I do more comparative statics, because that window of opportunity that we talk about, when does the abnormal return die out? 2 days, 3 days, 4 days? If you ask me, Gail, what should it be, 2, 3, or 4? What do you think my answer is?
Try all.
Sorry?
Try the different days. Try all of them.
Exactly, all of them. So I do my regressions for each of these thousands of regressions. I do for 2-day window, 3-day window, 4-day window, and say if the results are different. That's been the biggest contribution of our big data storage and processing abilities and methods, is we can say, you know what, we'll do it for all of those. And then choose models on the basis of those. And if your results are not robust to all these changes, then you're doing something wrong. Only when your results are robust to all meaningful specifications, only then can you say you're confident about your results.
That sounds a lot of work.
Oh yeah. Yes, it is. Thank goodness for modern computing methods.
Was all the like response in like the insignificant between the market efficiency and the volume, the trade volume?
These are all the rejections are at 5% level of significance.
Wow.
So you can see, I mean, for NASDAQ stocks, no rejections. So basically what it means is that market efficiency is not really affected by volume. But the thing is, why did I do a one-tailed test? Because the alternate hypothesis is the conventional wisdom. So by rejecting, if you did a single-tailed hypothesis, that's not particularly interesting as a statistical test, because that's not what you're trying to test. The conventional wisdom is not that they're impacted. Conventional wisdom is that it is impacted in a particular direction. So that's what a rejection should mean something. And so that's why, one-tailed tests are very difficult to do, because lots of computations have to be done over and above, because all your standard tests are two-tailed hypotheses. So yeah, so that's basically this. Once you, which is why I have received a lot of pushback. People are like, oh, which is not what we have seen so far. These are different from what we have thought about. So I'm not sure I like the results. That's kind of the approach that a lot of people have. You're going against conventional wisdom. But it is what it is. The data are what they are. You just have to respect data, as long as your methodologies are correct. So that's why if you read the papers, you will see I spent a lot of time developing the theoretical model and to do a bunch of, as I said, over 10,000 regressions for each result.
I mean, that's, I can imagine how valuable would this be. That's like over, I can't believe how many gigabyte have you downloaded for the data, and try to prove, prove the empirical results.
Yeah, so not gigabytes, Shing, it's terabytes. Yeah, my cloud data space is over 20 terabytes of data. That is 20 million megabytes.
I mean, like,
Professor, I think you can use Excel for this research. I mean,
no.
if you use Excel, the computer will get stuck.
Right.
So data or SAS, I guess.
Yeah, exactly. I use SAS for all my research. Yeah.
SAS is better.
SAS is the platinum standard for big data work.
Professor,
Stata, for instance, one of the problems with Stata, which many of you are familiar with, Stata takes all the data into your memory at the same time. So 20 terabytes of data, you cannot. On the other hand, SAS goes row by row. So given however big your data set might be, as long as you have the storage for it, it will read row by row by row. So SAS is actually just real. Look, R and Python, those are great as well. But for statistical purposes, SAS is really the platinum standard. So all my research is in SAS and consulting. Yeah, so Excel is not, will not work for this.
Professor, when did you publish the paper?
Well, there are many different papers. Let me pull up. I forget these things.
I mean, like, are there anyone like trying to development the idea based on your what do you figured out?
hang on just a second. Can you see my, so this one, Options and Market Efficiency, a Big Data Approach, that's been published as a book. Objective Measures of Market Efficiency Applications, that's was published in the Berkeley Business Law Journal last year. An Option Theoretic Market Efficiency was also published. Last year has been my best research year ever. I had 5 publications in the last 12 months.
Wow.
Yeah, I mean, it's a purple patch. This one here, which is probably my best paper, it is still under review. It hasn't been published yet. But you can look at the draft. You can look at the working paper. It's there on SSRN. So yeah. So I continue to do work on this. I'm kind of wrapping down in terms of market efficiency. I mean, you know, I've been working on market efficiency for over 10 years now, so I'm kind of bored. Well, bored is not the right word. I'm like, okay, I have no new ideas anymore. So, you know, any of you can come up with new ideas. Let's write a joint paper together. Open challenge to every one of you. All right, so let's try to wrap up today. So as I mentioned, you have next week, you have your final exam. I'll email you this Friday around noon. Please reply to your email with one Excel file, and we'll take it from there. If you have any questions, please feel free to email me. We can definitely set up a phone call or a Zoom chat between now and your final exam. And as we have discussed before, going forward, we can always, you know, we should always keep in touch. I'll always be your professor, and we will keep in touch, and I'll be happy to participate and help you out in any which way. In particular, if you're looking for jobs in the US or internships and so on, please let me know. It would be a pleasure to celebrate all your success going forward. All right, so hope you have a great week, and I will see you again shortly. Take care, all of you. Stay
Thank
safe.
you, Professor.
You're welcome.
Thank you, you too.
Thank you.
Thank you, Professor.
You're
Thank you,
welcome.